So last week, we saw the collapse of SVB and even Signature Bank. And we saw a really close collapse to that of Credit Suisse, one of the biggest banks in Europe. And unfortunately, we're not out of the storm yet. I made a video a couple days ago saying that, okay, I finally think this whole entire Credit Suisse thing has finally come to a close, but apparently not. So here I have with me today my friend Mike, the guy that does technical analysis here on the channel, and he has a couple of news in regards to this whole, actually it's not even news, more developments for this whole banking collapse that's currently happening wide at this point. So boy, do you have any, what's the information that you got so far?
So we're going to go back 24 hours and we're going to walk you guys through this because this is a developing story. So, things are subject to change from the time of this video to whenever you see it. But like you said, you thought the Credit Suisse thing blew over. Boy, was life about to hammer us in the face again. So USB, which is the largest bank in Switzerland and one of the largest banks in Europe, and regulators are rushing to close a deal on Credit Suisse. That was as of Saturday evening reported. So as we were going through it, they're trying to push for a deal on Saturday evening. That fell through, which is Sunday, basically. They still have not reached an agreement. And some of the key highlights from that is that Deutsche Bank also was looking at possibly acquiring Credit Suisse. So the regulators are actually trying to get the banks to buy Credit Suisse. They're trying to offshore all their assets to those banks, have them buy it to basically shore up liquidity, which if it was a healthy bank or in Credit Suisse had liquidity and all this stuff, why would any of this be happening? It's showing that we know there's certain things that are behind the scenes of how really bad it is if you have regulators trying to offshore the bank before it even declares bankruptcy, insolvency, or whatever.
Well, let me add to that. On top of that, this is after Credit Suisse got $54 billion from the National Swiss Bank.
Yep.
So the fact that they got $54 billion and they're still trying to, do all of this, oof, man, they're really bad right now.
They're up, what creek with no paddle.
Yeah.
So afterwards, they basically said U.S. authorities weighing in on possible Credit Suisse deal. So,
So now U.S. authorities, not just Europe, but now U.S. as well.
How many times do you think Yellen's come out in the last week and said everything's fine? I don't think she believes it anymore.
Nobody believes it anymore. It's insane.
And we'll get to that. There's a juicy bit to that, guys. So afterwards, Credit Suisse Investment Bank said there were key sticking points in the discussion. So that's basically telling you that USB wants certain contingencies.
UBS, by the way, UBS.
UBS wants certain contingencies before they even acquire Credit Suisse. And one of those contingencies was UBS seeks approximately $6 billion in government guarantees for a potential Credit Suisse takeover. So they will not touch this bank unless they're handed $6 billion off the get-go.
And that's on top of the $54 billion that the Credit Suisse got from the Swiss National Bank. So it's a total of $60 billion.
Yep.
$60 billion. So obviously, if UBS buys it with a $6 billion, down payment, plus the $54 billion that Credit Suisse got, last week, $60 billion in total. That's insane. Absolutely insane. But
and also,
what else do we got here?
The other question, they got that $54 billion as a loan, so they have to pay that back to the.
Yes, that's right. So that's 100% correct.
UBS is saying no. We want $60 billion as a gift, as a down payment. That we don't want any of this to go back to you. Like you're handing us as here's a favor for taking on this risk. So they want to be compensated.
It's just like, how badly do you want us to take Credit Suisse off your hands? How badly? $6 billion? I don't know. Maybe the offer will go up by 10 or like $210 billion. Who knows, right?
And the thing is, the government scoffed at it. The government, if they really wanted to get rid of Credit Suisse, instantaneously, would have said, yeah, well, here you go, take it.
They would do it for 20.
They probably do it for a penny at this point.
Yeah. But no, they will go higher and higher and higher because they really will want to get rid of it.
So afterwards, Credit Suisse and UBS declined to comment on request for commentary about what was discussed. So, it's still a sticking point. It's similar to how SVB, where, we're going to have someone buy it. There's a couple bids coming in. A week later, there's still no one want to buy it. So,
SVB, right?
yep, SVB. No one wants to touch that
wants to buy it.
kryptonite bank.
It's still being held by the FDIC.
Yep.
Here in the US.
I just have to throw some comedy into this. This is breaking news. I love this Twitter site that we'll link down in the description below, guys. You can follow it. Really, really good news source. And then, credit. They're asking for $6 billion, and Swiss government. The best I can do is $20. And if you follow Pawn Stars, you know that famous meme. But
yeah,
going into this is where it really hits home for us in the United States.
And this was just as of and this was just as of 18 hours ago, so not even 24 hours.
Saturday night, and it's actually developing even further. You may have heard it on the mainstream news because I saw certain news networks already covering this. Mid-sized U.S. banks ask FDIC to insure all deposits for 2 years. Ooh. So they're saying, yep, they want the same treatment SVB is getting for mid-sized banks. This is 200 banks saying this.
So we're talking about FRC, we're talking about Zion, we're talking about like pretty much all the regional banks that aren't SVB and Signature Bank at this point.
And it actually got even worse. Mid-sized banks coalition in a letter to regulators. So this is 200 banks, basically in a conglomeracy, sending a letter, an officialized letter, meaning this is not some CEO saying this, not some regulator. This is, hey, we're in trouble. They're basically saying the FDIC to insure all deposits for 2 years. And that brings me to my second point of the discount window, as it's called. This wasn't actually very public. And there's a reason for that, because this is where all the dark money basically goes. That if you look here, this is where banks go to get a 3-day loan. Banks don't like having 3-day loans with high interest because, well, there's only one person that can provide that, is the Federal Reserve. And during the financial crisis, this chart is in millions of dollars. So you hit over $110 million during the great financial crisis. And then when 2019, when the interbank lending spiked to 21%, it was 43 million.
And this was also during COVID.
Yep. So
this was also the COVID, because you see there April 1st, 2020, and COVID started, well, at least the
March.
whole, it started in like late March. It was actually around this time, if I'm not mistaken.
So for all those people that don't understand what this means, basically this is banks, like we said, panicking. You're at the grocery store, you have no food, no gas, and your first credit cards decline, second credit cards decline, third, fourth, fifth. You have no cash, your ATM card don't work. You're calling every single person that you know to get money because you are starving to death. This thing surpassed the financial crisis. This is basically more banks in history going to the Federal Reserve saying, "Hey, help, or we're going bankrupt."
And once again, this is coming back to what we talked about, that, or at least what I talked about as well, that we are seeing almost an identical repeat. I know they say that history doesn't repeat, it rhymes, but we're honestly seeing almost an identical repeat as of 2006 and 7 and 8.
Which is really weird, because
it's very, very weird.
Talked that we didn't think the banks would do it. We didn't think housing and the banks would do it, but gosh.
The only difference from today and 2007 is that it's not with mortgage-backed securities. It has to do with mainly with high interest rates and bonds. Yeah, that's like the only difference. Aside from that, it's almost the exact same thing.
And it's not even like, it's ironic because it's not even like mismanagement of banks necessarily. It's just like the banks are stuck because they're, like me and you covered, they're forced to buy these bonds. They have no choice.
Well, it's not that they're forced to buy these bonds, is that they bought the bonds at a really high price. And then with the rise of interest rates, the bonds fall. So now if they hold a 10, 20, 30-year bond, and it's at a negative because the bond price fell from when they bought it, and they need liquidity, they don't have liquidity because the bond is so far out when it comes to the maturity date. And then on top of that, well, it's at a negative, so they can't sell it either. Yep. That's the main problem here.
And just going back to the mid-sized bank, so basically they sent the letter to the regulators. They're basically, and then in the letter they say, despite the general health and safety of the banking industry, confidence has been undermined in all but the largest banks, basically
and
the big six.
And we have been seeing that. Yeah, and we saw that like in the live stream when I pulled up that story of like the top 6. By the way, you said 6 banks. I'm going to go with 5 because I don't consider Wells Fargo a top bank, like honestly. Wells Fargo is like number 6 out of those 6. But Like we saw that, like people are taking money out of the regional banks, out of the mid banks, because they're afraid. They're afraid that they're going to collapse, so they're putting it into the big banks. The problem is that the big banks can only take in so much money up until they can't anymore.
Yeah,
so that's a problem.
Until they're basically like hemorrhaging risk.
Right.
And the thing is, a lot of these big banks, they'll loan against their own shares or their own like capitalizations. They'll use that as a leverage in a lot of transactions because, simply put it, they don't have enough money on hand per se, but then you create value through the offsetting with shares. And how lopsided or underwater are these banks becoming?
Are they going to have to issue shares now to do all of this stuff? That's my concern. Because if they're going to issue shares, that means dilution when it comes to the stock. And, you know, that's like one thing. I have killed companies, like when analyzing them through fundamental process. I have killed them just because just because they're issuing shares at a massive rate. Like, okay, free cash flow's going up, net income is going up, revenue's going up, shares outstanding is up like 200% in the past 5 years. Just like, no. No.
And the other thing, like, FRC hasn't failed yet. And look what they're saying right here. Mid-sized banks coalition of American letter to regulators. If another bank fails, the deposit flight would accelerate. Meaning,
100%.
If FRC actually goes under,
exponentially, it would accelerate.
Yep. If FRC goes under, you will see bank runs like no tomorrow.
Instantly. Oh yeah. Oh yeah.
And the thing is, it's not going to be bank runs on the small banks. It's going to be the JP Morgans, the Goldman Sachs, the Bank of America.
I don't agree with that. I think you're going to see more of a flight to those big banks, but you might see, you know, a crash. Well, you will see an influx of people going into those banks, but I think you might see some people take it out of those banks too, because they're like, well, SVB went down. Now it's extended to all these other ones. If it goes to more mid-sized banks, then people are going to start saying like, oh, it's going to come to the big banks eventually. So might as well get out now.
Because people also, like, my own opinion is going to be this, like, if you have money in the big six banks, you're basically playing the suicide game with the government where I dare you to let this bank fail. Because if one of these six go, you're going with me. So, like, yes, you'll lose everything, but the government will lose everything with you. So it's like,
dude, if let's say Wells Fargo, I would say the bottom of the six, Wells Fargo goes under, like, that is like 20% of the U.S. economy, or like 15% of the U.S. economy, instantly gone, disappearing.
Well, would you like to know Wells Fargo's number 4 actually? Goldman and Morgan are actually smaller. Yep, I have it listed in order.
No, JP Morgan cannot be smaller.
JP Morgan's number 1, Bank of America's number 2, Citi's number 3, Wells Fargo's 4, Goldman Sachs is
Goldman
5,
Sachs. Okay.
And then Morgan Stanley is 6.
Okay.
I have them listed in order on the watch list just so I can understand which one's which.
All right, good.
But this, and then again, they're also citing this massive influx of the liquidity and loans for the banks. And then UBS is set to offer $1 billion for Credit Suisse equity, but Credit Suisse is set to pushing back against the UBS offer. So literally, so they're saying, okay, we'll offer you $1 billion for your entire equity portfolio, which their equity portfolio is 1.6 trillion. So they're basically discounting it by 98%.
And on top of that, remember, UBS won $6 billion as a gift from the government.
Yeah. So this is actually, I believe, is separate. I believe UBS is going to Credit Suisse and saying that we'll give you this for this, right? So they're basically saying, like, to Credit Suisse, like, hey, before this gets ugly, you want to do a side deal and basically say, screw the government? But basically, if we keep going, so currently the market cap of Credit Suisse is around $8 billion. So here's the scary part. Credit Suisse manages 1.6 trillion, but is only worth 8 billion in collateral. It really brings into question of, if a company is managing that much and they're worth this much, that means investors don't believe that any of that assets will actually pay out or provide a income to them. So if we keep going up, it's basically, they got the offer, and then breaking Switzerland weighs nationalizing Credit Suisse in full or part.
That is insane. That is you told me that. You showed me this before making the video. And I'm looking at this, I'm like, nationalizing Credit Suisse in full. That is literally the fear. That's literally the fear of this whole entire banking collapse, that at least here in the United States, that the US will nationalize some, or I mean, to be fair, SVB is already nationalized because it's controlled by the FDIC. But could you imagine if that extends over here to the regional banks, where the government takes over all the regional banks?
But here's
That would be insane.
But here's the problem. It doesn't have to. The future doesn't have to happen in order for people to discount it now. They're going to see this, and they are going to panic like no tomorrow. And
Absolutely.
just quickly jumping over to XLF, because this is really crucial.
And by the way, to everybody who doesn't know, XLF, it is the spider index for the financial sector, the SPDR.
And if you guys follow any of our videos that we talk about, and whenever you do ticker requested Fridays or anything, I talk about this till I'm blue in the face, and I'm going to keep talking about it until I'm blue in the face, guys. You're right at the 200 weekly moving average. This is your long-term price of being bullish. You break this,
it's just downhill.
Well, just to put into perspective, so you had the big run up on XLF, and you have another trend line here forming off of the double bounce of the COVID lows, and then the recent bounce in October. So you're right on this trend line. You break that trend, you're going to the 200 next. Do I believe that 200 is going to hold based on the news that's just coming out and the increase in volume? So, price confirms.
Yeah, look at that. I'm just looking at the volume down there. Look at all that selling volume.
So right here.
Look at that. Yeah.
What is this the start of? Let's go back in history and see what happened when volume spikes like crazy. Oh, that event.
Was this 2007
2008?
or 2008?
You see, volume ramps up, and afterwards when it forms a bottom. So could this be the start of that? And the answer to that is going to be very simple. It will be the start of that if you break this trend line. You break this trend line, all hell breaks loose. And, well, probably your next stop.
What is the yellow line, by the way?
The 200 weekly. So that's your long-term moving price. And you're probably coming back to fill this nice, juicy gap down here, sitting around
so that white line that you got there, that's not the 200.
No. So actually, let's just...
Okay. I got confused there for a second.
Right there. So you see how close you are to that 200? You got another...
I mean, the wick is pretty much on it.
Yep. So from close price to there, it's going to move up to probably... You're at 0.5%.
That's not much.
Well, the scary thing about these ETFs, these spider ETFs, they're not meant to move 2-3% in one day. I've been seeing XLF be moving almost about 2-3% on the day.
Yeah.
So that's not normal for these ETFs. ETFs usually, because they're a conglomeracy, they take a lot of time to get to a certain price because they're stable. They're a conglomeracy of multiple.
They got all the companies in there, right? They got the regional banks, and they also got the big banks, right?
Yep.
But at the same time, it's just like all of them are crashing. So
And the scary thing is, if you break here, you'll get a debt cap bounce at 10%. You'll come down, probably crash through this gap that you have here. And everyone knows my opinion about gaps. They all get filled in time.
Oh, that gap right over there. Can you zoom on that gap?
Yeah, sure. Let me do this. So that's about probably, I'm going to guess, a 10% gap right there. So bottom of this wick to body of this wick, 8%. So you're going to send right through that 8% gap right there like it's nothing. Well, there's no price action to support you. Look, what was the historical price action in there? Rejection off of this, that's not a lot of price structure, and then the big COVID crash. So there's not a lot of structure there, which then allows price to move very easily. So hypothetically, and this is not going to happen in one day, I say that and then watch it happen in one day.
Yeah, probably.
we said the same thing about Credit Suisse, so anything's possible at this point. Pretty much. You basically, to this trend line here, which is the all-time low connect of .com and COVID, is a 32% haircut on a stock that got already a 15% haircut.
So let's assume best case scenario, bring that to the top of that gap, or at least the bottom of that gap right there. How much would that be? Assuming that it fills the gap and then it bounces back up. How much of
22%
a crash would that be? How much?
22%.
22%. So if the gap really does fill, which gaps always fill, that means that we still got 22% more to go on the financial sector. If that's the financial sector,
which services all other sectors.
Right. So yeah, this is gonna be an very interesting upcoming weeks, if I'm not mistaken. And remember, I thought that the whole Credit Suisse saga was done when the ECB came out saying that like we're going to increase interest rates by 50 basis points, but if you guys need liquidity, we'll give you liquidity. And then they got the $54 billion from the Swiss National Bank. I thought it was over, but apparently not. This is insane. So yeah, this is probably going to be a big crash. And I don't know if you want to go back to the whole news cycle.
Yep.
Do you have anything else to say here? Because
Let's just see if they got any more news while we were talking.
Okay, yeah, just do that. And
so here's another one. As part of a bank's rescue deal, Swiss regulators are considering imposing losses on Credit Suisse bondholders. So basically, if you didn't incentivize those bondholders to basically run ship, you just did. So get ready for that massive sell-off next. And then which will then, if they sell their bonds, which will cause yields to go up.
And that was as of 1 hour ago.
Yep.
As we're recording this video, it is 12 p.m. Eastern. So, yeah.
Loss on bondholders could need to be larger if Credit Suisse was wound down rather than taken over by UBS. So basically saying the same thing that politicians are saying. Stakeholders, bondholders, you are screwed.
And if you look up there, FDIC said to move forward to break up plan for SVB. Swiss government is to hold an important press conference later Sunday. Oh boy.
I hope it's before open because that market ain't gonna be pretty when it opens.
You mean 6 p.m. Yep. Right? But then take a look at that one right there. As of 47 minutes ago, 2 major banks in Europe examine scenarios of contagion and look to the SCB and Fed to step in with statements of support. Which we already got a statement from support of the ECB, as I said. But what we're going to get from the Fed on Wednesday, that's going to drive so many things. This is literally going to be the break it or make it point when it comes to the Fed. Are they going to stick to their mandate of stable jobs and stable prices, or are they going to play into other types of things and save the markets, save the financial sector, save the banks? Because that right there, that's huge. That's huge.
Or is it going to be where the market absolutely just doesn't care? Like you mentioned this a while back, a couple of months ago, that you said we're going to get to a point where the market ultimately does not care what the Fed says or does. They're just going to kind of do their own thing. And we're kind of seeing cracks of that now where you're seeing Fed come out, say, oh, we're going to support this, we're going to support that. But, well, market's like, okay. We don't care. Look at FRC.
Oh, well, here's the thing when it comes to that, right? This whole thing happened because of the rise of the interest rates. So if the Fed starts the whole pivot narrative, or at least phase 2 of the pivot narrative, which I said is going to be a pause, and again, we're going to get that on Wednesday. So eyes glued, no matter what you're doing, you're going to get your eyes glued to what the Fed says on Wednesday at 2 o'clock and then 2:30. Because if they do that soft pivot where they're going to go into phase 2 and make a pause, if Jerome Powell comes out saying, due to the current banking scenario, we are going to make a pause on interest rates just so that way the banks can catch up to the rise of interest rates. If they do that, you will see massive increase in the markets. Because do you think that they're going to stop that temporarily?
I think that whatever they say, even if it's a bullish reaction at this point with the contagion that we're seeing with Credit Suisse, you can have a bullish reaction, but I think it doesn't last. I think it gives you maybe a couple days of reprieve, but I think the fear, because you've seen it, the second any hope gets put back into the market, fear comes right back in and smacks it right back down.
I understand that. But do you think that the Fed will say, we're going to stop raising interest rates temporarily? Do you think it'll be temporarily? No, it won't. It absolutely won't. So this is the beginning of, if Jerome Powell, again, it all depends what happens Wednesday. If Jerome Powell comes back saying, we are going to make a pause on interest rate hikes for the foreseeable future because we want to see what the banks do, and that way they can catch up to the interest rates going up, the next step will be they're going to start cutting interest rates because it's not going to be enough.
We got to see, because
we will.
We could see Powell make one misstep in a statement because, he's human. He could make it or answer a question. The questions are going to be more important than his statement, because he's going to give a statement, and usually the market kind of is still, they hold off on having a big move until he answers some questions, like probably 5-6 questions in, and then you start seeing the move.
When we have precedent for that, because we have seen that before. But Tell us, guys, what you think about this whole entire thing. Do you think that the Fed will actually pause interest rates? If so, why? And if not, why? What do you think about this whole Credit Suisse saga continuing? Because apparently it's not over yet. And most importantly, what do you think about the whole Swiss government nationalizing Credit Suisse? And do you think that it will come here to the United States? So with that, I think that's where we're going to end it right here. Like if you like, comment, subscribe. It really does help out with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out, and we'll see you all next time. Final words, boy?
No, just stay liquid until Wednesday.
Peace out.